Jason.
Hey, Reg. Happy Friday.
Happy Friday. We always seem to be recording on Fridays.
Recording on Friday. You're listening to this on a Thursday, but
yeah.
It's investment planning month here, so we've got a lot of investment portfolio related things sort of on the agenda over the next few weeks.
Yeah, what do you talk about in those investment planning consultations with folks?
Lots, right? Yeah, I mean, like there's kind of from the top down, right? We're looking at risk tolerance, time horizon. We're looking at the risk assessment. We're looking at risk capacity. We're looking at financial planning goals. We're looking at short-term cash needs. We're looking, right? There's this like kind of laundry list of things that we are exploring ultimately to make sure that a client's investment portfolio is right aligned with their life, basically.
Well, that kind of brings me to the big question of today's episode.
What's that?
Why invest? Like, why do people invest?
Right. Like, what's the point? Why not just like keep the money close by and safe and like, yeah, not have any risk, right? Like, not have any potential downside. And yeah,
I know you're going to tell me like people invest to outpace inflation.
Sure.
That's why you don't keep dollars under your mattress, like, or just keep it in a savings account or even a high yield savings account. Like, I get that.
Okay.
But my question goes further.
Okay. How so?
Like, to go back to the cash under the mattress, like, why save? Why invest? Because you want to do stuff with that money, right?
Yeah. Well, I mean, you ultimately have a use for it, right? If we're just collecting money to just like hold on to it and look at it, right? It's probably not doing what it should be doing, right? That's the whole purpose of it, is to use it as a means of conveyance to like gain resources that you don't already have. You think of this like a video game at this point, right? But like you're trying to you're trying to pay for things, right, that ultimately make your lifestyle the way you want to live, the things you want to do, the trips you want to take, the backyard you want to have, whatever it is, right? You're using this means of trade that is just money, right? And so back to your original point of like, I'm going to say that, right? Absolutely. Because, right, like it's one of those fundamental things that happens in a healthy and growing economy, is the cost of those goods and services will increase because the economy is expanding and there are more requirements to keep that expanded economy growing, which includes an increase in costs and an increase in capital.
Absolutely. And I feel like a lot of times we invest not just toward our goals, but in the hopes that what we're saving will grow more along with that economy.
Sure.
As we're stashing those dollars away. Yeah,
we're looking at productivity of money to ultimately determine sort of like what you have of like how you can make or structure your investment portfolio to be the most effective it can for you. Like, and when I say productivity, and we've talked about this before, it doesn't necessarily mean that it's like invested in the most risky thing and it's growing at 10x or whatever. Productive money can be an EFOF, right? Where it's safe and it's close by and it's easy to get to. That's part of your productive money plan. And then it is at the other end of the spectrum, the riskier assets, maybe the longer dated things like a Roth IRA, where you're trying to get as much price appreciation as you can because it's all tax free, and you're holding your riskier and more aggressive assets in there, right? All of that is a component of productivity. Right. And investing is just it's a huge sort of component of it, right? Because ultimately, like if all of your needs were in the immediate term, right, like you wouldn't invest at all. But that's not true, right? We have a future, we have, events and things to pay for.
Yeah, we have milestones. We have things that we want to do with our money. I like to call them goals, but we don't just save for saving's sake. We don't just invest for investing's sake. We do it so that we can get somewhere, do something.
Right. Like we want to retire. We want to go see, I don't know, go see Rome or right. I'm just coming up with things that ultimately like you want to do. And yeah, you can potentially some of those things along the way, right? Especially in your higher earning years, You'll be able to, take a family vacation that's, relatively expensive, but you'll be able to pay for that through cash flow, right? Potentially, right? In some scenarios, right? And so it's like there's these little things that you can do, but then there's also these things where it's like, I want to buy, a $2 million house in the mountains, right? And all of a sudden, right, the requirement to get there is going to likely necessitate that you're going to have to carve out some of the dollars that you have, kind of like positioned for something else. And you're going to say, okay, that's for this project now. And I'm going to invest my money in that way to support that goal.
So people are going to invest their money in that way. How is that different based on the type of goal or maybe the timeline for that goal? Or is it all the same?
Well, the timeline, right? The timeline determines a lot, because if it's like something you're going to do in the next 6 months, like you probably are not taking any risk whatsoever with that money. It should just be cash in the bank, right?
Mm-hmm.
If it's 3 years, okay, now you have a more limited sort of scope on some risk you can take. But even then, you're going to use something fairly conservative like bonds that will just sort of edge up, get you a little bit of yield, and just grow your money. So obviously it keeps up and maybe does a little bit more than inflation. And then when you go beyond like 5, 10, 15 years, you get this really long-term dated thing. Then you're thinking of more aggressive types of investments, because you have time to recover. Like, you don't need this money for 15 years. If the market pulled back, sometime during that 15-year period, like, you have a time to recover, right? And again, in a healthy and growing economy, the market, right, tends to edge up and to the right, if you will. So that plays a huge, right, obviously huge role in it. But the type of goal, I'm not sure, right? I don't think the type of goal really ultimately matters, but maybe you have some examples of where the type might come into play.
A little bit. But I think going back to the main question here, like, why invest? Well, why invest in the stock market? Oh,
sure. Like, why invest in the things we invest in, right? Well, the stock market, the answer I like to give about that is just the stock market is the easiest way to make your money sort of maximally productive, if you will, right? If you're looking at growth, right? It's very turnkey, right? And examples I've given, in other sort of alternatives, right? You could go buy a rental property. You could go start I like the hot dog stand metaphor, where you go, you start a hot dog cart, and you're running a sole proprietor. You're an owner operated business, right? That's an investment of money, right? Those things take work. Investing, buying a stock does not take, you just go put the money into the stock and now you own the stock and you don't have to worry about running the business. You don't have to worry about replacing the water heater, right? So that is why a lot of times when we talk about and think about investing and what that ultimately represents, the stock market being the thing, is because it's very easy. It's just very straightforward.
It's accessible.
Yeah, it's very accessible. Absolutely.
Okay, now I'm going to go back and answer your question about the types of goals.
Yeah.
I'm going to tie it into what you just said. Like, you could buy real estate. It's a type of investment.
Sure.
Well, and maybe you would if the type of goal that you have is to be a landlord, to offer housing to people, to work with people in that capacity. Maybe you want to buy that hot dog stand or hot dog cart because you want to be a business owner and you really like hot dogs.
Yeah, you make a great point here. There is a type of goal that matters here, and that is you have what I like to call means-based goals and ends-based goals, right? Mm-hmm. Like stating like a means-based goal is I want to be a landlord. I want to own rental property. Like I want that. Well, when you reach that goal, you just took an investment from one place and put it into a different investment, into the real estate, right? So it's the means. I want to retire at 58 with a $10,000 a year budget for, travel, whatever it is, right? That is an ends-based goal. That is the thing that you're doing all of these things for, right? Stock market, real estate, hot dog cart, doesn't matter, to get to, right? And so, those types, right, can ultimately determine some of the like inner workings of like, well, if your goal is to buy real estate and it's in the next 3 years, right? So we kind of amalgamate everything together. You're going to need a portfolio that's mainly, high yield bonds, some cash, maybe a little bit of stock exposure, but not much, right? And so we're going to try to just get there in as safe way as possible.
Yeah. And a lot of times that person who says, I do want to retire at age 58 and go do this, that, and the other thing, maybe they don't want to be a business owner with their hot dog cart. Maybe they don't want to be a property manager with their rental property.
Right.
I think it goes back to that accessibility piece. The stock market is open to everyone who wants to invest in it.
And I will say, as it relates to rental properties, because I've worked with a lot of rental property owners over my career. And one of the things I notice is that is a very, it's sort of counterintuitive, I think, in some respects, but it's a very viable investment means while kind of your working years. But once you hit retirement, oftentimes I have clients ask, hey, can I maybe step back from some of these rental properties, or what can we do to sort of, lessen the burden, if you will, with that, and transition some of my portfolio into something easier, something more straightforward. Where, oftentimes maybe you'll probably think of it like, oh, well, when I'm retired, I'll have time to, be a landlord. Well, you probably won't want to, because you're retired. And from my experience, that's how it works.
Yeah. And the other thing that I like to think about when we're talking about investing is, again, stock market, easy to buy and sell. A business or a property, not as easy to sell. Maybe not as easy to buy, depending on what's available in the market.
You are hitting a nail on the head here as far as the term liquidity, right? Business, real estate property. I mean, there's probably, dozens of other potential things that would fit into this thing, but they're hard to sell, or hard in the sense that you have to go find a buyer. You have to, go through a whole transaction. You have to do a whole thing. It's like, there's a lot there where stocks and bonds and CDs, and just, if there's certain things where you can just go and just place, a couple of clicks on an order, or call somebody up and say, hey, I want to do this thing. And it's done. It's taken care of, and it's very liquid.
So I feel like when people are making this decision about what to invest in, they're also making the decision of how much risk do I personally want to take on. And you have a lot of control over your business. If you buy the hot dog cart, or your property, if you purchase the real estate, how does that translate into how much risk someone's taking in the stock market?
Right. Or just an like a securities-based investment portfolio in general. Like how do you control those factors, and how do you address those things? And the key thing to understand at the outset of that, right, is that there are far more things you cannot control. And that's ultimately true of anything, right? Like your real estate and your hot dog cart are, at the whim of sort of different, population growth, or all these different various sort of inputs that could impact the risk of it. But in stocks, bonds, securities, investing in general, right, there is elements that you just can't control. But then there are parts that you can control, and that's what we go through. We've talked about the process of assessing risk and understanding your tolerance and your capacity and all of that, right? That will lead to certain decisions that you can make about how you structure that investment portfolio, the types of things you hold and where you hold them, right? Asset allocation and asset location that are risk adjusted, right? Because we've looked at and assessed and understood your risk tolerance, your risk capacity, and so on.
Yeah, and you're not putting everything in one basket. Like, you might be putting a large portion of your dollars, the total that you have, into the property or the business.
Sure.
Also true for the stock market. You don't, just because you like a certain company doesn't mean you're going to invest everything you have in that single company.
You're going to, in most likelihood, like, try to diversify in some way. Now, granted, if you're going on the other side of the, hey, if you had a hot dog cart and that was sort of your life savings that you poured into that because you wanted to open this thing because you just, hey, that sounds like a fun thing to be doing, you are going to lose some of that diversification potentially, right? But as you make money with that hot dog cart, okay, what do you do with that? Do you invest it in stocks and bonds? Do you buy a real estate rental property, right? Do you do these things?
Or do you expand your fleet of hot dog carts?
Well, great. But when you do that, you've maybe diversified your geographic location for your business, but not necessarily the things that you own or invested in, right?
Mm-hmm.
So in stock and bond investing, like, one of the things that at least we focus on or try to make sure is done well is making these allocation and location and diversification decisions ahead of time, right? So that when the time comes where there's some event where you're asking the question of, like, okay, how should I react to this? The answer is naturally you already have. You've already done the things that you need to do because you've structured your portfolio this way. And so now you just let that work, let that happen, right? Going and futzing with it and, changing this, that, and the other. That is where oftentimes we get into, issues with, sort of getting out at the wrong time and not being able to get back in because you just don't know, you're not confident in when you should reenter, like all of that sort of stuff, right? So
yeah, it goes back to that level of control.
Yeah, absolutely.
Well, let's take it back to our main question as we get into today's takeaways. Why invest? And I think the big one here is for your goals, for something that you want to achieve with your money.
Absolutely. And takeaway number 2 for me is productivity of money, again, is important. And productivity doesn't necessarily mean that the money is invested. It just means that it has a role, it has a job, right? So it's part of your emergency fund. It's a part of your short-term cash needs. It's a part of your long-term investment strategy. Keeping money productive and in line and in order is a huge, huge sort of boost, if you will, to your future chances of succeeding in reaching those goals.
And takeaway number 3 being that your goals are ends related, something that you're working toward. Consider that when you're choosing what type of investment to invest in, whether that is the stock market or a business or real estate.
Now, if you want to tell us a little bit more or even explore your investing why, you can reach out to us at podcast@fpfoco.com. And you can also find our social handles in the show notes.
At FPFoco.
Well, hey, thanks for listening, and we'll talk to you soon.
Jason Speciner and Regina Neenan are investment advisor representatives of FPFoco, a registered investment advisor. The information in this podcast is provided for general educational and entertainment purposes only. It may not apply to you or your specific circumstances and should not be considered financial, investment, or tax advice.